Good afternoon, everyone. Today, I'd like to welcome to the show and introduce Monika Halan. Monika Halan is consulting editor with Mint. She is an MA in economics from the Delhi School of Economics and in journalism studies from University of Wales. She has worked across media organization and run 4 successful television series. She was an advisor to the Swaroop Committee, a member of the Bose Committee, and a member of the task force of the Financial Redressal Agency, and is a member of the SEBI Mutual Fund Committee. She is the author of 2 academic papers and the best-selling book, Let's Talk Money. You must have seen it in the bookstores. Monika Halan is based in New Delhi and was a Yale World Fellow in 2011. Now, in addition to this, she's someone who's writing. I've really enjoyed reading over 11 years right now. So, Monika, welcome to the show.
Thank you so much, Adil. It's a pleasure to be here.
So, we're very excited to be speaking to you as one of the foremost personal finance experts in the country, because during COVID, we've been getting tough questions from audiences, Monika. So the audiences have been asking us the questions which are hard to answer. We've told people that, yes, go ahead and pay your EMI if you can during moratorium. But the tough questions, right, is what we're looking forward to hear your view on. So without further ado, let me go to the first tough question and pose it to you. So the question comes from people saving, and these are people who are in debt mutual funds. And the question is simply, in light of the COVID circumstance and what has been happening, should I stick with my debt mutual fund, which I currently have, or should I move my life savings to a bank deposit? What do you feel, Monika?
Adil, it's an excellent question. And I think everybody was forced to think through some of those issues, especially when there was a freezing of the 6 schemes. And it looked as if that problem would spread. Also, when the market cracked, nobody really knew what would happen. So for those few days of absolute panic, I think you wouldn't have been human if you didn't think this question that should I rush to bank deposits? But then you had another thought that, oh, what happened to yes bank deposits and what happens to the cooperative banks which have failed? So there was pretty much nowhere to go to for safety. But it yet remains a really good question. And the answer to this really is that it depends. So if you are in a debt fund and you understand what you have bought, you understand the different kind of risks that you have taken through the debt fund. The debt fund typically will have a risk of the credit quality of the paper. So if you're reasonably confident that you have excellent quality paper, government securities, AAA bonds, if you know that there will not be a liquidity problem in the portfolio that you hold, typically that is linked to the credit quality of the paper of the debt fund. And the third is if you have matched your holding period to that of the fund scheme that you hold. Now, people don't seem to understand that debt funds are far more difficult to understand than equity. And there are a lot of variables in this. So if you have matched your holding period for the debt fund to it's called the average maturity of the scheme that you hold, then you're perfectly fine because then you understand debt funds. So in that situation, you're holding on to your debt fund, or you have a very good financial planner who has put you in the schemes which match your risk return, your profile, and your needs. You're fine. But if you don't know any of these things, and this is really your emergency money, this is money that you will live on in case your income stops, then a rush to a bank deposit is no shameful behavior at all, because this is really money that you will eat out of if everything else fails. And the nearer you are to your retirement age, the more safe I would want your emergency fund, your debt, the money that you want in 100% safe instruments has to be in 100% safe instruments. So it's a qualified answer. There is no, and Adil, you will know this very well. There isn't a yes or no. It really is, it depends. So is rice good for you? Yes, if you are a non-diabetic. So it's really it's a if you are like this, then the products work well. The only thing that I want to say is that there is no systemic problem in the debt fund industry.
Mhm.
Other products like ULIPs and other instruments that invest into debt funds simply don't do mark to market. They simply don't disclose their portfolios so honestly and so regularly, which is why investors don't do this panic movement away from those products because they don't know what is happening inside those products. So somewhere it is this disclosure which gets into the attention of everyone, including investors, newspapers. We are included in this, and that panic sort of bubbles over. So no systemic issue. If you have chosen your debt funds well, there is a huge tax advantage that you get, especially in the higher tax brackets. So no reason to run. They are not inherently unsafe, but you need to really know what you're buying.
Okay, great answer, Monica. So here's what I take away: no systemic risk. There is a tax benefit, and
Yeah.
most importantly, it depends. Firstly, I completely agree with you. Thanks for clarifying these three important points. In fact, in the Bank Bazaar white paper, we've quantified that tax difference. So we said that currently, the last 1 year on a liquid mutual fund, which is the safest of the debt funds, the return is 6%, 5 to 6%. FDs are also at 5 to 6%. But because of the tax benefit, if you hold the debt fund for 3 years, you make 1.3% more per year. So a person sitting today with 2 years of debt funds saying, should I move, should be aware that 1.3% per annum or 4% over a 3 year period is what they stand to lose by switching. But great answer. Now, one of the things I want to do in this discussion is give each question a slight twist to hear your opinion. So the twist on the first question is, you answered me for debt mutual funds. Should I move or not? The same question, but for equity mutual funds. Should I stick with my equity mutual funds given the market, or should I shift my life savings to a bank deposit?
Again, where will you go? Literally, what is this flight to safety? There is risk everywhere. And if you have been in equity, this was actually not the time to exit at all. If you were holding equity products, this was actually the time to rebalance and buy more, because I think as investors don't seem to understand that asset allocation actually has a meaning. And when there is the word called rebalancing, that actually has to be done both when the market is in a bull run, when your equity portfolio rises above your declared risk appetite, and when markets crack and your asset allocation goes below what you want to hold in equity. So the answer is, in this case, a qualified no. You don't exit out of equity at all, because this has been, I hope, a considered decision. And I hope you are not moving to constantly buy last year's winner. So if people are now saying that, oh, I'm going to rush to gold, remember, you're buying last year's winner. And if you had wanted to buy small caps 2 years back, you were buying that last year's winner. So you really have to figure out that, why are you in equity? Is it a considered decision? Do you have a runway of at least 5 to 7 years ahead of you when you don't need the money? If you're ticking all of those boxes, then you absolutely don't need to exit out of equity, because we are not going to go back to living in caves and running around on bullock carts. Economy will get back on track. People will consume, incomes will come back. And usually there's a bounce back when consumption, everything has been suppressed. You see a bounce back, and we've seen a little bit of a run in the equity market already. I'm not saying it'll sustain or not sustain, but markets go up and down. Get used to it. If you're in equity and you can't take volatility, you are either in the wrong product or you don't know what you have done. So if you are asking this question, then I think go back to either your planner or go back to understanding equity, because do not buy equity and then say, oh, I lost money. All that has happened is that either your product was not fit for you. I mean, you bought a product which was last year's winner, or you don't have the appetite for volatility. So understand the difference between volatility and risk. What you face in equity, in say an ETF or an index fund is volatility. Risk is what happens when an emu farmer runs away with your money. I mean, that is risk. So you really need to understand why you have got equity, what through what product are you taking this risk, and for how long are you committed.
Uh, I'm taking away the following. You can stay with your equity mutual fund. Don't panic, but have the ability to hold, like you said, for that 5-year horizon. Now, this is an elegant answer, but it's so interesting and ironic that even though things are volatile, we're saying stay in equity, while for the
Correct?
previous answer we said think. Irony, but so true that if you have 5 years, you're probably better off sticking with equity. And if this was money you needed in 1 year, you shouldn't have been in equity to start with. So thank you for sharing that. So we now move to the second tough question, and we're getting a lot of this from younger people. I think the first question was from people who've saved money. The question on SIP or loan EMI is coming from younger people. So here's the first variant of the question, Monica. I have 1 lakh. I have a choice of either continuing with my SIP, or I have the option of paying my loan EMI during the moratorium, which exists till the end of August. How do I choose between this tough choice?
You pay your debts first.
Mhm.
So your investments are always happening after you have paid off your debt. So if you have the income to sustain both your SIP and EMI, obviously something has changed. So either your salary has been cut, or you're fearing a job loss and you're fast accumulating an emergency corpus. There can be these situations in which you suddenly find that there isn't enough money to do both, which is continue with your SIP and pay your EMI. If you stop your EMI and continue with your SIPs, you may be punting on saying that the return on this investment will be so much that what I lose because of this money getting added to my principal and paying that higher interest will get evened out. But that is not what investors do. This is a speculative mindset. I encourage you not to do these games.
Mhm.
It'll cost you a lot of time, anxiety, and sleepless nights.
Mhm.
Simply stop your SIP, continue with your EMIs,
Mhm.
because you don't want at the end of that 6 month period to pay a higher amount of EMI, because all of the EMIs that you don't pay get added back. And then your EMI amount goes up or the tenure will go up. So stop the SIP only in the situation that you don't have the money to sustain both. Please continue your EMI, because you can come back to your SIP in some time, but that loan needs to be dealt with right now.
Right. So this is a very precise answer. And this is almost counterintuitive because people think that during the moratorium, I don't have to pay my EMI. But let me repeat the precise answer because it's very important. During the loan EMI moratorium, given a choice, stop your SIP, but pay your loan EMIs. In our calculation, we have seen that, let's say you take a 6% liquid mutual fund, post tax after 3 years, you're taking 5.6%. But like you rightly pointed out, the home loan is at 8%. And we've had people come and argue saying, oh, but my investments make more. But I think Monica just pointed out that's not apples to apples. If you're speculating, yes, you might make more money, but the real financial comparison is the risk-free return on the saving and the 8%, 10%, 12%, whether it's a personal loan or whatever debt you have. So very precise answer, choose the loan EMI. Now we're going to add a twist to the question, Monica. So the twist is as follows. So I don't have money to either pay my SIP or the EMI during moratorium, but I do have savings. Now the tough question, right, is should I liquidate my assets or savings and continue to pay my loan EMI, or should I make use of the moratorium?
Obviously, the SIP is out of question now. Your back is against the wall, and you have that EMI on your home loan or car loan, but you do have some assets. I would create a waterfall of assets that I would start picking out to liquidate. That is why we buy gold. That is why there are liquid funds. That's why there is an emergency fund sitting there. So I would start with selling gold, and you could actually sell a little bit of gold, then come to liquid funds, FTs. You go down this list, and the last product that I would want to use is my equity portfolio. I don't want to dip into equity. I would try and see what assets I have that I can liquidate. Typically, I would start with gold, look at my debt funds, what liquid funds do I have, what fixed deposits can I break. People have actually dipped into their PFs as well. So if you are dipping into your PF, promise to yourself that you'll pay yourself back, because that future 60-year-old self will hate the 30-year-old you later if you don't pay yourself back. So please, download an aging app. Look at your face when you're 60 years old. And then remember what you will say to this younger person, that dude, you just, took away my Starbucks coffee once a week. So do that math. And if you have to withdraw from your PF, please pay yourself back. But do not stop your EMIs.
Got it. So again, you've given us a very precise answer, which one would say is counterintuitive. So even if you have to liquidate your assets, you should consider doing it in order to continue paying your loan EMI. Now, in our calculation and BankBazaar white paper, we've said that let's say you take an FD 6%, post-tax 4.2%, add a breakage fee of 1% on the breakage, but still you're better off paying off that 8% home loan or that 12% personal loan rather than holding on to the asset. So that was very interesting. You also introduced a concept which is new to me. Thank you for sharing this about the waterfall of which asset to sell first. I found that very fascinating. That was a new learning. And you hit upon a point which a lot of people are asking us. They're saying, should I buy gold now? But can you repeat what you've been saying about gold? I know this is not part of the tough questions, but people keep asking, should I buy gold now? But what you're saying is exactly the opposite.
No, I am saying, and I say this again and again, that when you ask me questions, and not you, Adil, but when investors ask me questions saying that, should I now buy gold? Should I now buy debt? Should I now buy equity? My answer is that should you today be eating rice? Should you be eating vegetables? Or should you be eating meat? Do you even ask yourself such questions, that is it a choice between vegetables or grain, or is it an and? So don't look at your portfolio pie as an or, gold or equity, debt or gold. No, it's an and. The whole logic of a portfolio, the whole logic of an asset allocation is that you need all the products all the time. The proportion will vary according to your age and your goals. So just as a 18-year-old will have far more sugar, starch, carbohydrate, protein, but an 80-year-old will have a very different diet. They both will eat similar nutrients, but the proportions will be very different. It is no different in investing. That is exactly what you're doing. So yes, you need gold, but no, you don't need gold invested in jewelry. You need gold today invested in either sovereign gold bonds, because they are fantastic, they give you actually an interest, or a gold ETF. 5 to 10% of your portfolio is what you should maintain. But are you rushing in your equity into gold today? No, you will lose. You'll come back next year and say, oh, should I buy small cap now? Because you know what, small caps did well. Or, oh, let's buy international funds. They're doing so well. That's not how we do it. You always, when you ask these questions, go back to the diet example and say, I want a balanced diet. I want all the products all the times, but I will vary proportions.
Excellent, excellent. So thank you for sharing that bonus question on should you be buying gold or not. Now we're going to go to the third and the last of the tough questions that consumers have been grappling with during COVID times. This question, tough question, will come with a normal variant and with a twist too. So here is the first tough question. Should I pay my insurance premium my insurance premium is coming up. It could be my term insurance, it could be my Mediclaim, it could be something else. Should I pay my insurance premium this month with my income or my loan EMIs during this ongoing moratorium? And I have to choose one of the two.
You're not making this easy, right, Adil, today? And these are probably choices that people are facing. That yes, the money suddenly has evaporated and it looks as if good times are over. I would actually encourage you to think about your insurance as a good insurance and a bad insurance. Whether uh, I would put a pure life term policy, especially if you have dependents, you have spouse, dependent parents, children on your income, and you have a term insurance policy, that is a policy that you have to fund come what may, and you have a medical insurance policy for yourself and your family and possibly your parents, whoever it is who is dependent on you, that medical insurance policy must be funded. So if it is a choice between my EMI and my good insurances, I will choose my good insurances. If it is a choice between the more EMI and bundled investment, which is insurance, so either it's a ULIP or it's a money back endowment whole life, I would actually talk to the company for a period after which I can pay. Most companies will allow you to do that today. But I would encourage you to relook at these non essential insurances, masquerading investments, masquerading as insurances, which are actually not doing your money much good. But for that, I would pay my, I would continue with my EMI and not pay that premium, ask the company for a time waiver for a while, and actually use this time to reconsider some of the products that may be sitting in your portfolio, like an endowment, a money back, which don't do you any good. They make money for the agent and they make money for the insurance company. They do you no good.
Right. So if I understand this right, you've given me a precise answer. If this month I have to pay my health insurance premium for my family, and I have to pay my term life insurance if something, God forbid, happens to me and my family needs to manage. If those premium payments are coming up and I have an option between doing that or paying my loan EMI during moratorium, the clean, straight answer is pay the insurance premium. You should not be without term life and health.
Correct. Absolutely.
Okay. Okay. Thanks for the precise answer on that. And now for the twist, right? So it's now October. It's September 1st. So the moratorium is over, and let's assume for a minute that the moratorium is not extended. So the same question, but the moratorium does not exist. So it is September. I have a insurance premium due, and I have a loan EMI due. The moratorium is over. How should I respond to this tough choice?
Now you've really not only got the back against the wall, you've got a gun against the head. It's like one of those movies where it just keeps getting worse and worse and worse. So this is the time that you pull out all the stops. So if you ever bought things like you've bought invested into gold, you invested into anything else which has value, this is the time to actually sell all of that to meet your commitments of paying off the loan and making your insurance premium. Raiding your PF is not a bad idea at all, but find the money. If there are parents who can support some of this, ask them for a personal loan, of course, between parents and kids. But try and find the money from your own resources, from your own assets, and pay both, because this is a temporary blip. It'll get over. But the damage which will happen to you and your family if that home is repossessed or the car is repossessed, and I'm not even talking about insurance premiums, you have to make that payment. So if there is a final additional thing that there is nothing, then I would say, your insurance premiums are very, very important. Even if they take the car away, for instance, well, okay, what can you do? But then if it is a home loan, again, you will have to actually go talk to the lender, the home loan company, the bank, and ask for an extension of the time for payback. But I would be loath to give up a term insurance policy I bought at 35, where I'm paying 8,000 rupees for a crore of insurance. And today, if you're 45 and you go back into the market because you've missed one premium, and here your premium is now more than double because it grows exponentially. So it's really about losing that entire advantage that you have built up over time on a cheap term insurance and medical cover. Of course, you cannot be without in a time like this. So I would just say use the assets that you have, liquidate them, and make your commitments. And please pay those two premiums.
Got it. So, what you've said is, and again, you mentioned this earlier, your loan EMI is an obligation. So, that's non negotiable. So, if there's no moratorium, there's no question of even talking about if or whether you will pay. You have to pay your loan EMIs. Don't let that insurance go. It's very hard to get that quality of insurance when you're older. Speak to your parents, speak to someone who can help you out, liquidate your assets if you need to, but keep paying your term life premium, keep paying your health insurance premium. So that was a
And
great.
yeah, so I would just like to make an additional point here, which is to say that I'm saying all of this assuming that you have cut your discretionary spends to the bare minimum, that you're literally just spending the bare minimum to on your groceries to stay alive. Your club membership, everything is gone. I mean, please don't think that you can maintain your lifestyle and then ask these questions. So, the generation who grew up in the good times may find this a very difficult time, but draw upon the experience of your parents and grandparents. Every generation will have its hard time. And maybe you guys are lucky in your 20s, you've seen hard times early on. So, just learn from it. And if your EMI bill was higher than 30% of your take home, just use this opportunity to go back to under 30% for sure, and so that you're never in this situation again. So just
Right.
get over it and learn these hard lessons.
Right. Thank you for pointing that out, Monica. So I think I assumed that if you were going through these three tough choices, that you had answered the easy questions, which was the
You don't
discretionary.
know millennials. You don't know Generation Z.
Okay, thank you for clarifying. The easy questions we've not even dealt with on the show. We've literally dealt with the questions that what do you do when you're pushed to a wall and you have tough choices between A and B. So with that, we're at the end of the tough choices. We're almost at the end of this discussion. But I just want to open it up to you here, Monica, one of the top financial writers, advisors in the country. Now, we've had a few humorous moments, but this is tough times for folks out there. I think everyone is feeling it. Any words that you would like to leave, people who are listening with, saying that any words of advice in terms of money management for the next 3 months, which is, concluding remarks from your side?
All that I can say is that whenever there is some event like this, it's actually a huge opportunity to rework whatever errors, whatever mistakes, whatever things which we had not done. And staying at home, having this time out, actually can actually be a very, very empowering thing. So go back to the drawing board, see what is important to you, and then use the time to actually build your financial plan, because you really must act according to a script in your money. Otherwise, you are dancing from one product to the other, from one agent to the other. So, here is the time to script out the rest of your money life and use this time of great peril, great uncertainty to actually sit down and plan it out.
That was very nice. I think that what I hear again and again from leaders and industry experts such as you is use this crisis as an opportunity. It's very easy to say the 10 things that are going wrong, but it's also an opportunity for us to evaluate, not connected with personal finance, but I'm getting a great opportunity to spend time, a lot more time with my daughter, since we've been in the work from home situation. So use it as an opportunity. I think all leaders right, are leaving us with this advice saying that stay positive, stay hopeful. So, with that, Monica, I want to thank you for your valuable time. You've head on given us very precise answers to these three tough questions. I hope people go out and buy your book, Let's Talk Money. Thank you very much for your valuable time. For those of you who enjoyed this show, thanks for listening. Please follow my Facebook page, and we'll keep coming with great interviews with industry experts such as this one. Thank you, Monica, and goodbye, everyone. Please stay
Thank
safe.
you so much.
Thank you.
Thank you so much, Adil. Thank you all for listening in.
Thank you. Thank you. Goodbye.